I said we'll go. No choreographed answers here, so I mean we'll go.
Okay, so we're live now.
Cool.
Nice. So we started off a bit late, and it was my fault. Apologies for the tardiness. That's not our brand. So I'll just start off with saying hello to everybody that is joining us this edition of the Fintech Open House. The Fintech Open House, or as we call it, the FOH. So I think there's some feedback coming from somewhere. Let's just check that out. Right, so the Fintech Open House is a forum where we discuss issues or topics, concepts that pertain to the payment industry and the fintech industry at large. And so Payment Law came up with this forum so that we can discuss things that pertain to all of us, but maybe are discussed individually in our office or in our different groups so that we can share perspectives openly and learn from everybody. We normally stream to YouTube, and it's persisting on YouTube as well. So you can go back to refer to snippets and excerpts of the video. This is our first edition for this quarter, the last quarter in 2021. And I'm very, very pleased to have with me a longtime friend. Not really seen him since COVID, right? So a longtime friend, and I'll let him to introduce himself. And we're going to be talking about third-party processing today. Tunde, over to you. I think we can't hear you. You need to unmute.
Oh, my bad. Yeah, my bad. Sorry, that's my bad. Have a habit of staying on mute when meetings like this. So yeah, hi. It's a pleasure to be here. My name is Tunde, as you said, Tunde Okufi, and I work in payments, and I'm enthusiastic about payments. So.
Is that all? That's a very, very humble, very humble introduction. But we are already running against time, so let's swing right into it. So what I'm going to do today is I'm going to set a structure for our discussion because I mean we could go on and on. In the past where I've broached this topic with you, I think we spent more time than we are hoping to. So we'll just have the first 7 minutes or so to do the definitions and clarifications, because that is very necessary for us to clarify terminology before we jump into the subject. And then we'll jump into TPP proper, where we will discuss or unravel the value chain, the participants, the various components and layers, and perhaps the regulations that dance around the operations in TPP. And from them, we'll discuss other things like technology mix, if it's complex or not. There are a lot of ideas around there being some complexity attached to TPP and even payment processing, in general. And then we'll discuss the future and take a few questions from the audience, and we'll call it a day. Is this fine?
Yeah, that's fine. I'll particularly be looking forward towards questions from any participant, because I find that conversations on this subject always work best when there are questions, because it can be a bit broad, so we're not just speaking far and wide. So yeah, questions would also be welcome. But yeah.
Awesome. So the Payment Log team, are we good on the YouTube side? All right, so let's jump into it. So I'll start off with some definitions and clarifications. So people mix these terms a lot, switching payment processing and third-party processing that would henceforth refer to as TPP. What are the differences between these two? Are there blood lines, or is it one and the same thing?
Yeah, okay, thanks, Sophie. There are blurred lines. There are significant similarities, but it all depends, and very often depends on point of view or perspective, from what angle you're looking at the subject from. So there are broad overlaps and similarities, which is why people get the lines crossed very often, but they're also very distinct differences and separations as well. And through the course of this, we will hopefully get get through them and, provide more clarity. But to start off, I think because it's about definitions, yeah. And, when we've had conversations before, and when we're having a conversation, I think recently it was something around, you had used, I forget the word, but you used the word in a particular context. Now, like, okay, it's right, and it's also not right. It depends on the perspective, right? So, okay, so to begin with, I think one thing that is essential to sort of explain all of this. Now, third-party processing, switching, firmly resides in the world of cards and cards payments and schemes, right? So to kick off, I think it's important to describe what that world looks like, yeah? And you have essentially two general methods. You have, that's where you hear things like the four-party model, right? For a scheme. So you take your typical global scheme, they either run a third-party model or a three-party model. Well, to be fact, the three-party model is really literally only one scheme that I know that runs a three-party model, but I'll describe that. And what's a four-party model? Four-party model, and who are the participants? There's the acquirer, there's the issuer, there's the merchant who is allied to the acquirer, and then there's the customer who is allied to the issuer. So there's an issuer, that's an acquirer, there is a merchant, and then there is a consumer, and that describes the four-party model. The three-party model is similar to the four-party model, except that the issuer and acquirer are the same entity. And you find, one global scheme. I don't know if we'll be mentioning schemes as we go along, but it's up to you. There's one global scheme. There's one global scheme that uses a three-party model, and the major difference is that in each market, they would license only one, because what's scheme processing? Like, so if you're talking about the big card schemes, it's a franchise business, right? So they create a big brand, they create a network, and they franchise members, right? So you join that network, and therefore you can issue cards that bear the marks of the brand, and you can accept cards that bear the marks of the brand, but it's essentially a franchise business, right? So in the three-party model, they would only license one entity per market, and then everybody else goes to partner with that single bank or that single entity. But really, those are the participants when you're talking about scheme transactions, and when you're talking about processing, or you're talking about switching, right? Now, the role you play and or the setup or the interaction between those four different parties, so to say, is what defines or determines whether or not it is switching or whether it is processing, right? So let me start by maybe a definition for switching. Now, in both scenarios, in both what we call which is why I say it's point of view and perspective, and what we describe as a processing scenario, there is switching going on as well. The question is whether or not you as an entity are the one providing the switching, right? So in a switch scenario, you have the entity from your perspective, both the issuer and the acquirer. When I say them, you're connected to both of them and you can reach both of them, right? So the switch is the entity who sits in the middle and can reach both issuer and acquirer and can deliver transactions from one entity to the other, so from institution A to institution B, because you're sitting in the middle, right? You might not be connected directly, which is when we start to evolve into processing. But if you're sitting in the center, you are acting as a switch. You're connecting, you're the central entity that can find both the issuer and acquirer, and you perform settlements, amongst other things. But just to close the loop on a particular transaction, after it has been authorized, you're also the entity that can offer settlement, because once again, both the issuer and the acquirer have a relationship with you, and you can settle accounts, settle positions at the end of the day, right? So that's switching. And very often in what we describe as a switch scenario, there isn't any entity sitting between the switch and the institutions. There isn't any entity sitting between the switch and a bank, or that has issued the card, or the switch and where the transactions have been acquired. That's a switch scenario. Now, if you take a switch scenario and you think global, right, then you start to go into processing. You think about the fact that these large global schemes don't have connections in every market, direct connections in every market, right? Then therefore enters, a processor. And third-party processing, as going back to that four-party model, you realize that, I didn't mention a TPP, I didn't mention a processor, right? Even the schemes didn't even, and are not listed in that four-party model.
I was about to say, most people favor what they call a six-party model, and not a four-party model. They think the four-party model is obsolete.
Again, it depends on the perspective on what world you're. So this conversation I'm having on first principles, right? And you can start to evolve it as you want, but the core and the base of it is four. You can extend, and so it's a six-party model, and you include the scheme, and you include a payment gateway, for instance, which is what a lot of people start to do. But again, that's just similar to the conversation we had before. That's again someone explaining something from their point of view and their perspective, and creating content and creating content for what the general public. And most people interact with a payment processor when they're concerned about payment processor, when they want to receive payments online or they're trying to pay for something online. So you find a lot of those definitions that are geared towards that, payment processor perspective. And when we say payment processor in this instance, it's an entity that helps you collect card information online or, some other, form factor details and pass that through the network to the issuer or whoever has issued that token for authorization, right? So,
okay, so
I digress. We're talking about
and we are still on the first subject. Can we just move into defining what TPP is?
Yeah. So, which is where I was going, saying that you notice that there, in the model, in the four-party model, even extended it to what you call a six-party model, there isn't someone described as a third-party processor, maybe closest to maybe the gateway, and that's because the third-party processor is external to the relationship. From the scheme's perspective, you're a third party. That's why it's called third-party processing. Remember, I mentioned that it's a franchise business and members, institutions join as members. There's no member category, so to say, for a processor, right? When you complete your certifications and implementations, you'll be designated as a member service provider. So you are a service provider to members as well, and that's how you join. But you're not designated. You're not really part of the four in there. So now, a third-party processor is someone that is then licensed. Traditionally, the institutions that would participate in card payments are banks. They're banks. They're not traditionally technology companies, right? So they need a vendor, aka third party, to help them with all the technical requirements to process card transactions, which would include, all the certification and integration with the scheme. Obviously, the third party is the one that is then directly connected to the scheme, right? And will receive transactions from the scheme, inbound transactions to the scheme for onward delivery to the issuer for authorization, or would receive transactions for outbound transmission to the scheme if it's an acquired scenario. But essentially what the third party does is, or the third party processor, you either playing the role of an issuer processor or an acquirer processor. Sometimes you may be the same entity playing an issuer processor or an acquirer processor in a third party processing scenario, but really all you're doing is you're helping fulfill one side of the overall delivery of the transaction. Now you may be sitting on two sides, but you're not seeing it end to end, so to say, right? So if we're to use, I don't know if maybe using a transaction flow will help illustrate it better. When I said in switching that the switch doesn't need an entity sitting between it and the issuer, it and the bank, for instance, to deliver or send a transaction. Now, the difference here is, let's take an acquired scenario. You're at the point of sale at an ATM. You've given them your card, they've charged your card. Now that transaction will come from, if the terminal is being driven by the bank, in the case of an ATM, it will go from the acquiring bank. Instead of it going directly to the switch or going to the scheme, it will come to a third-party processor, right? who would then deliver that transaction onto the scheme and say, oh, this transaction was acquired by this institution. And with all the details in the transaction to clearly know that, oh, okay, this card belongs to this bank. The scheme then looks for that bank, either directly if the bank's connected to the scheme directly, or to identify that institution, the issuer's third-party processor, to send that transaction to the issuer's third-party processor, who would then forward on that transaction to that bank for authorization. And then, the response comes back the other way.
That's fair enough. I can't see the questions from YouTube. I imagine a couple of people will have questions or we'll need to go over that again. But whilst you are discussing that, whilst you are breaking that down, you spoke about the value chain and the participants, so the participants of the four model, but you also spoke about issuer processing and acquirer processing. And we're now coming into some of the terms we hear people talking about when they're explaining their business and also when they're raising funds, and all that, like, oh, we're in merchant services, we're acquirer processors, we're merchant gateways and different things like that. We have this relationship with this bank because we are co-acquiring, with them. So could we go into the components and the layers we have in this TPP business? Because it looks like there are different layers to it.
Sure. So let me start off on the issuer side and issuer processing, for instance. So as an issuer processor, I mean, in the simplest terms, you're helping connect the issuer to the scheme or to the network, right? The wider global network. Now, the issuer has issued a card. That card can go anywhere in the world or any place that the acceptance marks for that scheme exists. They put in their card for acceptance, right? The scheme would, because you're the issuer processor for that transaction, the scheme would find you, send the transaction to you, and you have a direct connection to the scheme, to the bank, sorry. You have a direct connection to the scheme on one hand, and then you have a connection to the bank, and then you deliver that transaction to the bank, to its CBA, to its core banking application for authorization, right? So so your customer, wherever they are, can get value. That's essentially what issuer processing is. It's a bunch of things as it's as an issuer processor, you're managing the acceptance or delivery of transactions, or aka transaction routing, and making sure that those transactions are formatted to the right specifications and standards. You're helping the issuer, stay abreast of scheme mandates, because the scheme will, make changes and or change things for stipulate changes that you need to stay abreast of. So, for instance, migrating from static data authentication to dynamic, or contact only cards to contactless. All of these kind of things are the kind of things that an issuer processor needs to stay abreast of, right? So that the client or the bank can, focus on, essentially the core of the business and don't have to staff at that kind of team.
So in my mind, things are beginning. Okay. So in my mind, things are beginning to converge, right? And it looks to me like somebody that's a business that is already a switch in a particular domain would also be best positioned to offer TPP services. Or if you're offering TPP services in a market, then you should really explore switching, because the strengths sort of complement each other. Is this something you can comment on?
Yeah, it's two sides. It's almost two sides of the same coin. Or if you're to use other terms, it's about maybe if you start as a switch, it's almost like vertical integration. If you understand what I mean, like, okay, I can do this, but to become a processor, I just need to add on, other type of capabilities, and have, as a switch, you can run. And you've seen this with your experience in different markets. Very often, the payment infrastructure, the payment network in a particular market will start out as a proprietary scheme, so to say, not based on global standards, but it works. You can deliver transactions from one institution to the other. It's authorized. Everything is fine. But then when you're thinking when you have a more global perspective, then obviously standardization, making sure that your system is able to interface and interact and send messages, to more global schemes. Then obviously, you need to expand your standards to a more global perspective. So yes, there is a strong relationship, as is clear, between processing and issuing, and capabilities often overlap.
So I interrupted your flow. You spoke about issuer processing. You're about entering into acquirer processing.
Okay, yeah. So acquirer processing, much like issuer processing, from a transaction perspective, involves connecting the acquirer to the network. So you will receive transactions from the acquirer and present to the network and say, oh, these transactions were acquired by this institution. And I'm sending it to you, the scheme, for onward delivery to the issuer. Excuse me. And then, that happens and authorization comes. And there are a bunch of things that may entail, really. You might just be providing acquire processing services to that entity, but there are a bunch of things that an acquirer needs to be successful. That's where things like merchant services come into play. Or where in our market we like to talk about a PTSP, which is essentially someone who would, now we're talking about brick and mortar, right? Mm-hmm. Essentially someone who would, go and visit that merchant and provide frontline support, provide education, maintenance of the devices, paper roll, all those kind of things. Merchant services are a wide range. It's almost, it's open-ended, yeah. But someone who is providing merchant services can, you can even extend to going to recruit merchants, for an organization as well, so yeah. So that's acquire processing. There are like two sides to it. So there's brick and mortar, and then obviously there's online, and that's where you then maybe a payment gateway will come into place, payment processing. A payment processor, which is the term that they like to use in this space to describe someone who collects card details for you. Gives you a gateway for you to integrate on your website, and enables you to collect card information or other types of information, process it for authorization, and so that the merchants can sell their goods and services.
Thank you. So I'll just take the question I can see right now. So Temitope says, I think I understand customer and merchant, but what are issuer and acquirer?
Okay. An issuer is the way I like to describe it. So an issuer owns the issuer in typical terms in trading owns the customer. That's probably maybe one way to look at it. I remember if we're talking about banks, every bank is both an issuer and an acquirer. So you all own customers. But in this perspective, since we're spraying it, across an issuer and acquiring sort of network, the issuer owns the customer. The customer's bank account sits with the issuer, right? The issuer needs to provide you an access product to access your funds, right? And in which instance they will issue you a debit card, right? Because you have funds sitting with them, they issue you a debit card as an access product to your funds. There are other types of cards. An issuer can issue you a credit card where you're not accessing funds that you actually have in an account, but you are accessing and or making use of a credit line that is given to you. But bottom line is that the issuer has a direct relationship with the customer and has issued them a card as an access product. An acquirer serves customers. Now, you might be serving your own customers, but you also are serving other people's customers as well. So when people come to your terminals, come to your devices, either a POS or a merchant that you acquire online or an ATM, they're helping your bank service you, but they don't do it in isolation. They need to take information from you, take that transaction, send it up either through a processor and a scheme or through a switch directly to your bank to say, hey, do you know who this guy is? Is he permitted to do this thing that he wants to do? Does he have enough funds for it? Yeah. So an acquirer puts out infrastructure for you and touch points for you to, as a cardholder, for you to use.
Awesome, thank you. So going back to the TPP question, right? If somebody still looking at TPP business, what kind of regulations control the activities you have in this sector, or help delineate the activities and regulate them, basically? What kind of regulations do you have, especially in our market?
So in a market, there are a bunch of licenses that you would need to obtain, and there are activities that are and or should I say capabilities or whatever it is that are permitted to you based on your licensing category, right? So now there is specific licensing to license as a third-party processor. Pardon me if I'm not sure, it's not the PSSP one. Pardon me if I don't get the exact name, but there's a license, right, for you to operate as a processor and requirements for you to meet. There are specific things I know, like, okay, so maybe key things maybe within our market, for instance, is since we're talking about cards, regulation says only a commercial bank can issue a card today, right? That is market specific regulation, different from maybe what a scheme would permit or allow. At one point in time as well, because you mentioned non-bank. I think you mentioned non-bank acquirers.
Yes, we're getting to the non-bank acquiring and what that was about and why it's just the switches.
So there was a time when only banks too could be acquirers. But I mean, even though the scheme had that capability, or I mean, within the scheme rules, you could you didn't. To be honest, things have evolved. So there was a time when to be a member of the scheme, they would only have financial institutions, but that's also evolved, right? You can be an acquiring member or even an issuing member of the scheme without being a bank. But whatever the scheme permits or allows still is subject to what the domestic regulations are. So maybe on the issuing side, for instance, only commercial banks are allowed to issue cards. So you can do everything else that you want as a third-party processor. It's just that, you can't issue cards because, you don't take customer deposits, for whatever reasons. In the past, you couldn't be an acquirer as well without being a bank. But today, you can be an acquirer because the domestic regulation changed to recognize a category which they describe as non-bank acquirers, but they've also set the criteria for that. And today it looks like it's only people, institutions that are switches and the third-party processors really that sort of fit that criteria. But the criteria is available for anyone to try to meet.
Awesome, thank you. So the next thing I'd like to discuss is, we all know EMV, right? And EMV sort of formed a standardization for anybody that was going to issue a card that had a chip on it, whether it was contact or contactless. And it was very easy for everybody to follow that, especially as we moved from the ISO former versions, even now to the ISO 222. But for this processing TPP thing, it doesn't look standardized. And then as you go from scheme to scheme, it looks like there's almost some deliberateness to confuse people. Like this sort of scheme would have issuing and acquiring, differently. And some other schemes would give out POS and web acquiring, and treat them differently. And some other schemes would be like, oh, there's this thing called co-acquiring. And it's just all over the place. Like you said earlier, some schemes still have the 3-party model and some schemes are now running the 4-party model. So somebody be wondering, are you guys trying to confuse us and, we're collecting money in different places? Why can't this thing be any easier?
Okay. I can understand when you talk about complexity, but you see the difference is when you reference EMV, you talk about standardization. All of that standardization exists. Now, all the things that you mentioned are all business and or strategy type differences, right? So business profiles in a sense, as they describe it in the scheme world. So there is, third party versus card issuance is all, EMV literally stands for Euro Money, MasterCard and Visa. It's their standard, right? And those are the, the large, schemes. So they came together to standardize. And the standardization obviously is in, messaging protocols, in a bunch of other things, how we would do things, how, everything covers everything from, card issuance, the guidelines for card plastic manufacturers to adhere to, the whole value chain of creating a card, value chain for creating terminals. So there's a lot of standardization. Now the differences that you mentioned are okay, in this particular scheme, if I give you a license, you can acquire and you can issue, you can acquire across multiple channels. Another scheme will say, if I give you a license, you can issue and you can acquire on the ATM. But it's a separate license if you want to if you want to accept POS transactions and/or web transactions, and we're not giving it to everybody, that kind of thing. Or in the three-party model that I described, where the issuer and acquirer in the typical model is the same entity and it's one end supermarket. But even there's always evolution, because even that scheme that runs a three-party model are running a more open model in our markets, for instance. So things change. Nothing is fixed like that. But when you talk about, if there are specific questions around complexity, maybe I can speak to it. It's just all of the things that, like I said, is strategy and business differences on from scheme to scheme, really, not really standardization. You can't force everybody to say, this is how I'm going to issue my licenses and this is what my licenses mean, and this is what you can do or this is what you can't do, right? Yeah.
Okay, so let me not belabor that subject, since that's direct entering strategy. Another important thing I would like to discuss is the interchange. So I hear in our markets, when you're working the field, you hear a lot of things about the interchange and then the costs with this interchange thing. And I'm wondering, it's been a while. Like, there are people in payments before I joined, and we're almost clocking, it's past 10 years now, and we're still on the interchange matter. Is it ever going to be disrupted? Is it ever going to go away? Interchange, let's discuss interchange.
Yeah, my question is, why should it be disrupted and why should it go away though? And maybe it's because people misunderstand what interchange is. Quite simply, and maybe if I was to use an analogy, in the early days of GSM, remember when people were talking about the price of making a call or making a call across networks, and there was this interconnect fee that was mentioned. And you need to think about the evolution of cards and card payments, right? And literally all the way up from where we are now, it's mimicking checks and literally card payments all the way up, up until now. And in the early days, essentially, a bank it was a siloed system, right? A bank issued cards, and if you could use cards that you can only use at the ATMs, right? Right, as an automated teller machine. Instead of employing a teller, they put a machine outside, so you go and take your cash on the weekends, right? But it only worked for your bank. Then schemes came up and said, okay, there's an opportunity here. Instead of with everyone building different silos, we can interconnect these guys. We'll build a brand around it. We'll call it, I'm not going to name brands, right? But essentially saying we can interconnect and provide interconnectivity between these guys. Now, if someone works like in the acquiring scenario that I described, when I said the customer, like someone comes to an ATM or a POS, that customer ideally belongs to another bank. You carry your First Bank card, your GT ATM, for instance. You're a First Bank customer standing at a GT terminal. You're not GTB's customer. GTB is going to serve you. You need to compensate GTB for serving you, or what's the point? GTB only serves its own customers then. Right? That's what interchange is, right? It's the fee, and depending on the scenario, so in the acquiring scenario, in the ATM scenario, ATM acquired scenario, the issuer pays the acquirer an interchange fee because the acquirer has made investments in putting that infrastructure there, putting ATM there, providing cash, and they need to be compensated, right? So it's not a cost, it's a fee. And then in an ideal scenario where I'm not, but in an ideal scenario, the issuer is supposed to be able to recover that cost for serving the cost that he needs to pay the acquirer. He should be able to recover that cost from his cardholder and have some income on top for himself, as well, because he's also, expended money in providing the card, right? In a POS scenario or web scenario, in a purchase scenario, bottom line, it is the acquirer that pays interchange to the issuer, because those cards are not there for, it's the flip that in this instance, it is the acquirer that's sort of getting the benefits in that instance, and the acquirer pays the issuer interchange. So if you look at it from that perspective, you realize that interchange can't go away, because that's the economic value within the system. Now, if you're looking at it as an acquirer and an issuer yourself, and you're looking at all your costs, you need to consider interchange as being one of your costs. You need to consider scheme fees as one of your costs, because remember, you're in a franchise, you franchise the brand, and they will take something for every transaction. Then you have a third-party processor that's helping you deliver those transactions as well. So quite simply, it's a cost-plus model. We don't like to describe interchange as cost, but yeah, it's something that you need to pay to, if it's an ATM scenario, something you need to pay to the acquirer. Then you have your scheme fees to consider. Then you have your processor fees for doing all of that end to end, and that is what will determine what your price is for serving the customer. Cost plus margin should be your price.
So all this you said right now has generated a lot of questions in my mind. As I was looking at you talking, I was just wondering, what am I permitted to ask you, and what am I not permitted to ask? Like all these costs. Also the cost of the card as well. And after getting the card as a customer, because I'm speaking from the perspective of the customer, you still go to the merchant location, and some of these costs that the acquirers, would pass on to them, they will pass on to the customer as well. So somebody will be wondering, and you don't need to answer, I'm just, it's rhetorical. Somebody will just be wondering, this thing has gone on for a while, and we're at the point where it should be commoditized, especially to have much more transactions that will benefit the estate owners, the owners of the infrastructure. So are we imploding the system? Are we imploding our ability to grow astronomically? It's just a thought, right?
Let me give.
Okay. Yeah.
Yeah. Let me give my views and perspective. So there is this assumption, and maybe this is what I was trying to sidestep. There's this assumption, and usually it will come from, or in our markets, come from the regulator. This assumption that there is some price elasticity, and that if you reduce, and by that I mean if you reduce price, you get a lot more transactions. To lower the price, a lot more people are able to transact. But the data actually hasn't held that up. Take for instance, when you need to know when something is growing as a matter of course, when it is growing because you've reduced the fees, right? So you take, and I'll give two examples. One, when transfer fees were initially slashed from, I think it was 100 Naira, and they were asked, and it came down to 50 before this last revision that is in bands. Following that logic, there should be the logic should then be that there should be maybe an equal uplift in transaction volumes for transfers. There wasn't. We didn't see that uplift. And we didn't see that uplift for years until the technology improved, the rails improved, there are a lot more use cases for P2P, and general adoption sort of picked up itself, is when you saw that change. So it's not always price elastic. It's not that when you slash the price and suddenly you see an increased activity. Another example is ATMs, for instance, reduction of the 100 Naira surcharge, first to 55, and then I think it's at 35 now. That has taken ATM growth. It plateaued ATM growth in the country, and we're now in a place where ATM and the conventional wisdom then, or the thinking was that we're far behind ATM real estate for our population, but we got to a place where there was no longer an incentive. And obviously that's created other opportunities. So, the markets are sort of adjusted. And that's why you see, agent banking has become a lot more popular. But agent banking has become a lot popular for that reason. But the truth is, there was a gap, there was a need. You slash prices, the people who you slash income essentially, and you created a disincentive for investing in that space. So there is a point. Yes, things need to be, affordable, and those things kind of happen naturally. And I think market forces and a free market should determine and define that. So what would have happened is that maybe someone would have looked and said, okay, for all my costs, maybe I'm able to serve my own customers, at a lower rate, and then they offer a lower rate, and maybe that way they're able to, win customers as opposed to when it's legislated. But that's probably utopian, because the world over, in every jurisdiction, these things are legislated, but it's not price elastic in that way that I slash prices by half, then I'm going to see a 50% uplift in activity. And very often it's detrimental to investment in that space and that sector. That's my two cover. Well, but the data is there. If in those two instances I mentioned,
I actually interpret the data differently.
And transfers.
I actually interpret the data differently, and it's not just for transfers. I think it's also for telco costs as well. When the SIM costs and the costs for making calls were at a particular level and then they were reduced. But again, it's arguable, and we can go on and on. I need to chip in one last very important question before we log off. We are really past time. So I just wanted to find out the future, because again, we're discussing how things can be more affordable and better and have more collaboration. So we're seeing different new forms of payments. There are lots of people that, because of some of these things we're talking about, they really think cards should go away, because it looks like the landlords of the card estates are not very open to collaboration. And so they will prefer something else, right? I've discussed that a lot on Fintech Open House, on whether cards will go away, or whether they can go away easily or not. But for processing, and for especially third-party processing, you hear things like, oh, we don't support this kind of transaction, and if transaction fails, we're going to get charged for it. I understand the principle of, well, it's passing through rails and the rails are working anyway, whether the transaction is successful or not. So why shouldn't we charge for failed transaction? But very specifically, things like the buy now, pay later, how are the card schemes and the TPP, especially since you mentioned something very important, that they are franchises. So I guess each region will have their own nuances and interpretations and priorities. So there are climes or there are markets that, based on the social constructs, identity and all that, it's easy for them to take on the buy now, pay later and sort it out without having an additional help from the card schemes with respect to payments. But there are also other markets that we need more help, because our social construct and structure for identity is not that in place, so it's exclusive. It doesn't include everybody. What should we expect from third-party processors in those regions, being the owners of the franchise?
Okay, it's a very long question. I'm trying to decide which parts.
Okay,
I'm trying to decide which part is question, which part is commentary. Okay, so let me just take a stab at different aspects of that, or what's next. Yeah, let me do that. There may be certain things that you had mentioned that we want to react, but maybe in the case of time, I want instead. But the future, there's a lot of evolution in the space. One is the evolution from ISO network level connectivity and connections, right, to more APIs and application level type of connections as well. That evolution, in a sense, almost lowers the barrier to entry and all that is possible, because suddenly you don't have to deal with this huge complex. You're not looking at ISO 8583 or other ISO. What's the other one that Swift uses now?
222.
222 to understand, very low level. It's almost like maybe in the world of development, finding a C, someone who develops in C versus, someone using, an
Python.
object-oriented approach using C# or using Python, and then you can imagine the impact that that's having, because that evolution is going on. That's what has, created the birth of the provision of a lot of, what we pay in the e-commerce space anyway, payment processors, because suddenly you can take APIs. Traditionally, before you'd take an API from maybe a processor or a third-party processor, but there's nothing stopping. So some of these payment processors can take APIs and connect directly to schemes as well. So it creates a lot of maybe democratization and opening and inclusion in the space. So that's, from a third-party perspective, there is you need to keep responding to the changes and to the differences as well. One, you need to have the capabilities to offer APIs as well. You also need to implement. Remember, at the core of it is that wherever there's complexity, and you mentioned that it's a complex space, wherever there's complexity, there's the opportunity to simplify it for your client. And then therefore there would always be a need for someone, there'll always be a need for a vendor or a third party to help you deliver value. So, and when you speak of specifically, you're talking about the buy now, pay later. The schemes already have products for buy now, pay later or installment payments, right? So those capabilities, everyone is thinking, the schemes are thinking, and as a forward-thinking processor as well, naturally, you'd be like, okay, before my client goes to figure out how to do this, I can figure out how to do it for them. And I'm one entity offering service to multiple people. So there's economy of scale there as well, as opposed to each person going to going directly to get service. I can aggregate this in a sense and serve my client base. There's a huge amount of evolution, even in tokenization as well, for instance, so card tokenization, people keep talking about, will cards be here tomorrow? Cards will die. No, cards will not die. It may not be going at the same rates and speed as P2P and account-based systems and other proprietary systems. But once there is a need for you to deliver value cross-border, obviously, because all P2P schemes they're talk, in Europe and in any case, about doing countrywide, country-to-country sort of instant payments. But they can talk about that in Europe because they are one economic jurisdiction. They're the EU, right? Yeah. So, there will always be need, and beyond even, when you're going cross-border, all of the robustness, so to say, that has been, built into card payments. As fantastic as instant payments are, you will still have instances. Someone still messaged me yesterday and said, "Oh, you had sent money to the wrong person. Now, what does he do?" Right? The finality that's in instant payments is entirely different from, in the card payment world, where there is still that, cycle of, maybe someone presenting, a transaction for it to be cleared, and you can say, I didn't take the service, or I no longer want the item and the goods, and you can change your mind, Yeah. So the use cases are not going to disappear. So cards are not dying, but there is an evolution towards maybe using those same rails. All these great things have been built. How do we modernize it and digitize it? So your card then transforms from some plastic that you carry to something that sits in your phone or sits on a ring or sits, on a hairpin, sits on wherever it is, and it's still leveraging the same global standards, the same, convenience and everything that exists today in the card world. So you may not see the card, down the line. You may not be putting the card into a terminal, but cards are not going away. The rails are not going away. It is still, we're having this conversation, a couple of days ago, when you're looking at all the different ways to move funds from one side to the other, move funds from one spot to the other, which is essentially what all of this is about. Card networks are still one of the cheapest, right? It's still the cheapest. The only one that is cheaper is, P2P. So
right, thank you. So there's a question in here on the chat. So for online lenders, one frequent issue with card payments is the non-reusability of VEV cards, I guess the tokenization. Some VEV cards cannot be tokenized for recurring debits. Any thoughts on why this is so? So I know you may not wants to comment
You may,
on this.
you may have to have a session and invite someone from Verve.
Okay, so whoever asked that, ask that in the comments.
But you know, those are very, it's a very scheme specific question. So I guess what the person is referring to is in learning world, you want to tokenize a card so that each time, you know, the person comes back, you can essentially replay the transaction without having, you know, the person to, you know, put in all their details. I guess I think it depends. I'm not aware of that particular issue. But if they were to escalate it to the right places, I'm sure it, you know.
So if you're online and you ask this question,
but
and
it's not a lack of capability or functionality on that particular scheme. You know, without knowing the specific issue, it's hard to speak to. But do I have my Verve card tokenized for repeated transactions? Yes, you know, I do.
Awesome. So
I do have other schemes too.
Okay, so I think we've come to the end, not for the questions, but because we're out of time. Thank you very much, Cindy. It has been nice talking to you. We can go on and on because there are some questions you did not respond to. I saw how you carefully sidestepped them. That's fine. We shall continue this discussion afterwards. But thank you very much for coming, you know, on here and sparing us a lot of your time. And thank you to everyone who is on the YouTube channel watching. I can't really see you, but thank you very much for your questions. Thank you to the Payment Log team as well. The next FinTech Open House topic will be on something very, very interesting, financial inclusion. I'm going to bring in a dear lady that has done a lot of work in the sector. There are different meanings and interpretations to financial inclusion, but anytime I see her and her products, I just tell myself, this is what we call the real financial inclusion. So please make it a date with us for that topic. Thank you, Tunde, and good evening, everybody.
Thanks, it's a pleasure. It's a pleasure chatting with you. It's a pleasure being here.
Bye.